We've got some of the biggest institutional investors in the space. We've also got quite a good gradation here between debt and equity investors. This almost sort of works on the line here, actually. I mean, Cath, you're an equity investor, really, from a VC perspective. And some of your colleagues here move in varying gradations between equity and debt, some more debt, some more equity. And it's, of course, it goes without saying that there are different considerations for equity and debt investments. Though what's interesting, actually, I think in certainly quite a few of the cases here, you do both quite often. Predominantly you'll be a debt-based vehicle, but you'll quite often go in with equity kickers and other stuff, so you'll be also looking at equity. So, and I think I haven't done the maths here, but I'm guessing, and Simon sort of, as at Liberum from an investment bank perspective, has probably also represented funds that have raised some of the biggest amount of money. P2P GI, for instance, was one of your businesses. So I suspect that if we were to add up the total amount of money institutionally raised along this line, I should have done this maths earlier, actually. I could probably have worked it out. But there's well over probably £1.5 billion on this line here, between £1 billion and £1.5 billion. Yeah, something like that. Of which the lion's share of that would probably still be P2P GI, followed by VPC, and then we'll talk a bit about what you've been doing as well from a private equity point of view, VC point of view. But so that's quite a lot of money. So that's quite a lot of money invested in the sector. So, and also we've got some international perspectives here because Geoff, your former perch at GLIF invested in many, many different countries' platforms. Nothing in Australia, I noticed. Simon, a lot of the funds you're representing are investing all around the world, as so's Victory Park Capital. And Cath, you're mainly Australia at the moment, aren't you?
Yeah, we're predominantly.
Is that on?
Predominantly Australia.
Yeah, predominantly Australia. So we've got a good international mix here. So that's a bit of the background. And what I'll do is I'll quickly ask what each of them does. So actually, Cath, why don't we start with you? Could you just very quickly give us a 20-second summary of what you do?
Sure. So I'm with Airtree Ventures, which is a venture capital fund based in Sydney. We currently have a $60 million ESVCLP, so that means we invest exclusively in the equity part of the capital structure. We specifically can't invest in the debt part of the capital structure. We're active in a range of different software sectors. And we made our first fintech investment in an SME lending platform called Prosper about 6 months ago. Great.
Thanks very much. Simon, just a bit of background about Liberum.
Okay. Liberum's a UK-based investment bank. We've been involved in the marketplace lending sector for around 3 years now. And as David said, we've been instrumental in raising capital for funds that have been invested via platforms. We've got three listed funds that we've raised in total about 1.2 billion pounds for. And in addition to that, we've also helped platforms with equity investments, equity fundraisers, and also undertaken a bit of principal investing ourselves.
Geoff, give us a bit of background.
Yeah, until December last year, I was CEO of GLI Finance, which was a business that invested in 20 alternative finance platforms around the world, in UK, Europe, US and Sub-Saharan Africa. I left in December. I was hoping to be able to say what I'm doing next, but pending signatures on pieces of paper, I can't be specific, but I will be doing other things in the alternative finance space.
Harsh.
Hi, I'm Harsh. I'm with Victory Park Capital. We manage around $2 billion in this space currently, and we're incrementally adding about $100 million of incremental volume every month. Most of the investments are actually in the US. The second biggest geography for us is the UK, followed by continental Europe, and we made our first investment in Australia towards the end of last year in a business called Zip Money. And we're looking at other businesses in Australia to add on to that exposure.
Okay, great. So let's just kick off, and I might just for the purposes of the discussion, slightly skew at the beginning more to debt, because actually that's probably where a lot more of the money's been, and then I'll come back towards equity towards the tail end. How's most of the capital being raised? I asked that question in a pointed fashion. It's really come in quite often by closed-end funds, hasn't it? And that closed-end funds brings with it its own advantages and disadvantages. Harsh, why don't you kick off?
So actually, the bulk of our capital is actually raised through private equity funds from institutional investors. So it's your typical pension funds, endowments, sovereign wealth funds, etc. And we ended up raising a listed vehicle in the UK, given it was an attractive source for us to diversify our funding base.
Yep.
Majority of the focus of the investors is actually on the debt side. They see it as something where it throws off a very attractive yield relative to the global markets right now without taking excessive amounts of risk. However, the investors are also looking for a little bit of equity upside. So we also participate in that. That's one of the things that we did in our recent transactions. And so we're...
What's the kind of yield? What yields are they looking for? I mean, the Larry Index, which looks at the top 4 UK platforms, Sam will correct me if I get this wrong there, but it was something around 6%. I mean, give or take either way, something like that. Is that what people should expect to be getting from you?
Well, so our track record in this space has been considerably higher than that.
Yeah.
So we've been lending since 2009. On a net basis, that return has been around 17%. Of that, 12% has been from the credit side, so our debt investments that we made, and the other 500-600 basis points has been from the equity side. We're promising, or not promising, rather, we're telling investors that we would expect to generate between 8 to 10% net for them, without factoring in any equity upside, and we're comfortably there. Our last dividend on the UK fund was 2p, which is roughly 8% annualized. So that's what we're expecting to generate going forward.
Geoff, looking at GLIF, your former business, again, are they reasonable expectations of return? I mean, your business was that business was very much focused on SMEs, wasn't it? So I'm guessing it might be slightly higher. I mean, give us some sense of the returns.
Yeah, well, I think that there's two aspects. Yes, it was slightly higher than that sort of level because it was very much focused on specific niche areas where you could get excess returns. I think the interesting thing from my perspective, as the platforms are beginning to scale to material volumes, there's significantly more business to do at slightly lower yields, and it's actually a conversation I've had with a couple of platforms here that as you're seeking to get more institutional monies, there is probably more business to be done at slightly lower yields that comes with significantly less risk, and to open up the sort of, I guess from my perspective, looking at the Australian market, the kind of nirvana is to be able to get the supers to look at this type of investment as an asset class, given the vast amounts of money they've got to put to work. But in order to do so, you're really going to have to look at much lower yields and very low risk products, but that could open up significant amount of lending capacity. And certainly in my latter days at GLI, that was one area that we were looking at, that a platform that was able to originate a lot at 8, 9, 10% could do much lower risk lending at 6 or 7%, which would attract significantly more capital in, but from traditional pension funds and some of the, particularly the investment banks, looking to invest their own monies.
Simon, you talk a lot to institutional investors in London. I mean, what's their mindset in terms of returns? Would they prefer to get a higher risk-adjusted return of, say, double digits, or would they prefer to go maybe slightly less risky down at 6, 7%? What's your feeling on what the institutional money is at the moment? What they're looking for in places like Australia, the US, and the UK?
Yeah, I mean, it's hard to generalise, but
yeah.
if you look at the weight of money, what do the bigger fund managers want? They want to make scale investments at reasonable returns, so they wouldn't be pushing the envelope in terms of return if a fund can deliver 6, 7, 8%. That's compares quite well with other equity investments they can make. But the sort of one missing piece in the discussion so far is leverage, and quite a lot of the fund vehicles, and including sort of the private LP structures, utilise a fair amount of leverage to get the returns beyond what you could if you were just investing directly.
Yes, because that raises an important question, because I imagine that what a lot of investors would want, we're looking at the interest rate cycle. They might be thinking interest rates are going up, therefore I'd rather go down the shorter end of the curve and get myself, quite low risk-adjusted returns of 5 or 6%, from shorter duration vehicles. There's quite a bit of stuff that's lurking around at 10% plus, but is that the kind of thing you want to do? But if you go for short duration, you're never going to make the fund targets you are, so you're going to have to use leverage, aren't you? Harsh, as well.
I mean, just to be clear, so when I referenced our track record earlier, that's assuming and that's using a quarter turn of leverage. Right. So it depends on how you structure your transactions, and depends on the areas of, as Geoff said, there are certain niches where you can put some capital to work, not the hundreds of millions of dollars that you can maybe in US consumer loans.
Yep.
But the risk-adjusted return is far more attractive. So that's something that we're actively looking at. I think on the leverage point, leverage is a key component, especially when you look at marketplace lending platforms. Ultimately, if you're looking at the higher quality assets, i.e., prime consumer loans in the US, good quality business loans in the UK, as well as the US and potentially in Australia, the net returns you're going to generate there are going to be in the single digits. So the question then is, after you take away other fees and costs that go along with it, is it a sufficient return to take that risk? From our investors' perspective, both the public side and the private side, the answer is no. And if you can get very cheap, non-recourse leverage from a bank with a view to doing a securitization later on, then it does make sense to do it. Okay. So same for us, same for P2P. The leverage limit on our fund is 1.5 times, right? Which is 10% of what banks typically lever these assets at. And a lot of these assets have been sitting within bank balance sheets for a number of years. So we do think that using leverage sporadically and using it selectively makes sense. Just using it to generate the return obviously is not something that we're looking to do.
Okay, so let's broaden it out now, Cath. Let's get you involved. So you guys are all here in Australia. You're all obviously looking to invest in platforms, one way or the other, low debt or equity structure. From a VC's point of view, what are you looking for in an alternative finance platform? And the reason I asked that question pointedly is because earlier on we were talking a bit about my mischievous rule of 4 or 5. By and large, a lot of industries get dominated by about 4 or 5 players. Banks, a lot of industries work that way, and it usually takes about 4 or 5 years to get to that scale. There's no new businesses to invest in, is there, Cath? I mean, let's just be honest. It's going to take them 4 or 5 years to get there. We're going to have 4 or 5 players, and they're all out there. They're all sitting around here listening to me. There's nothing new out there. Come on, it's lending, isn't it?
So I think echoing a number of the points that were raised in some of the earlier sessions today, that the industry is still very nascent in Australia. There's a ton of white space. And the awareness is so low of this class of finance that most of the customers that are on platforms in 4 to 5 years haven't even used a platform yet. So I think from that perspective, there's still a huge amount of growth, and that could come from existing players or new players. I think the interesting thing here is that the underwriting, the quality of the underwriting and credit decision requires volume. Yes. So that, I think, provides a real barrier, as well as access to continued access to institutional capital. In terms of what we look for, we're more tech than fin, I guess. So we're looking for really disruptive technology platforms that offer us, say, a 10x experience for customers relative to banks, and also enable a really competitive cost structure and scalability. And I think the other thing that we're probably quite focused on is unit economics, and that a whole bunch of things play into that around loan size, repeat rates, default rates, and acquisition costs.
Simon, you've invested quite as a bank directly, into the platforms in Australia. I think behind a couple of businesses here. What are you looking for when you invest in businesses here?
Well, when we first got involved here, it was nearly 2 years ago. Yeah. So what excited us at that time was the fact that it was very much emerging as an opportunity. And I'm sure there's still lots of opportunity here, but a lot happens in 18 months. And as an example, one of the businesses we helped introduce an investor to at the end of 2014 was Harmony, and you can see what a success that's been, and that very much was a first mover. And another business we're involved in Australia is Kicker Capital. Again, relatively early mover into the SME opportunity, but there are other things about that which made it attractive.
Such
and I think
as?
one of the key things is, can you see that business attracting institutional funding and broad range of funders to help it grow, and there are elements about what they Kicker's got in place, notably the Cabbage partnership, which you can see as a catalyst for that.
So I'm picking up a consistent theme here: scale, in a sense, an ability to scale quite quick, and an ability to scale efficiently, price risk efficiently. So that sort of suggests that it's game over, isn't it? You're going to just invest in the scale platforms. Simon?
I was just sort of totting it up in my head, the funds that we're involved in, and other institutional investors that we've put in as investors into platforms, have invested across in total about 40 platforms.
Okay.
Which gives you an idea of the room there is for people to develop.
Geoff, when you were at Glyph, again, you didn't invest in any Australian platforms, unless I'm right. There's sub-Saharan ones, but not Australian ones. Something going on there. Does that tell us that effectively, the big guys already here, that, some of our panels already invested in them, Arshur in some of them as well. That there's no room for opportunity. What I'm trying to tease out here is, what is it that you're going to need from a next generation platform that you would want to invest in? Because scale is going to be a big issue.
From my perspective, and the reason that we didn't come to Australia was simply logistical, that if you've got 20 platforms around the world, there's only so far you can go, and I don't believe you can really run a business properly from Europe. If it's in Asia, if we'd have had a partner in Singapore, we would have been quite happy to, and we looked at a couple of things in Australia, probably would have done. I think in terms of scale, I slightly disagree, and it was something which came out of one of the other sessions earlier, that there are some very good businesses that may not be able to scale as much, but have a very good business that can produce very consistent returns from a decent sized book across the cycle, and that's just as valuable.
What kind of niches are they, do you think? Effectively niches, aren't they? Where do you think they are?
Well, in SME, which has always been the area that I've focused on, you will have particular areas. A good example from our UK range of businesses, we had BMS Finance, was a business which lent specifically to high growth pre-profitability companies. Been lending for 10 years, lost money on one loan in 10 years because they were doing it right, charging 12 to 15% interest rates, never made less than a double-digit return in a year. That was a book that you could comfortably write a couple of $100 million in the UK. You could probably write similar amounts in other European jurisdictions. It's never going to be a multi-billion pound company, but it can consistently bang in 10 to 15% returns every year. That doesn't need to compete with Funding Circle.
Yeah. Harsh, again, you're actively looking for businesses platforms to deploy money to, and obviously you're going to prioritise the big liquid platforms that are already there because they can take a scale, but you're still interested in niches. So when you come down to Australia, what niches are you interested in?
So I'd clarify that we're partnered with some of the largest platforms there because we can do it in scale, we can securitize the loans at the back end, but we got involved in this business through looking at a small platform that's now much larger than it was. So we are always looking for interesting niches. In Australia, we like the small business element. We already have exposure to a consumer lending platform, and we're very comfortable with that platform, especially given that we've put equity in there. So we'll only do equity if we have a very high conviction on the outcome. So small business is one. The question is whether you play in sort of the element where, to quote someone, the Funding Circle plays in, or do you play someone where Cabbage plays? There's probably room in both for us to get involved in. There are other niches that we're looking at, which finding out more about on this trip, which could be interesting. So such as strata finance, which is an interesting niche over here, which is getting larger, and then other forms of consumer lending aside from just point of sale, which is also something that we're looking at. But the other point is, on scalability, there are platforms out there in the UK as well as here that are focused on pure consumer lending, so trying to be the lending club of Australia or the UK. The question that you need to ask yourself on scalability is, are they doing something really different from what the banks are doing, particularly if the banks are actually active? The reason why it worked in the US is because, frankly, the banks were just not active in that space, and they created a product that was far better. So that's something so if we find someone who either has an edge in underwriting or has an edge in accessing that end customer, then we were happy to get involved, even if the overall space is quite small.
Cath, I just wanted to pick up on that. That sort of talks to your point about use of technology. I mean, what are the particular skill sets and attributes that you look for in the fintech businesses with an emphasis on tech that allows them to compete against the banks? What are you particularly looking for there?
To give some specific examples in the SME lending space where we have invested, data access is really key. So integration to accounting platforms, credit providers, etc., that can be done in an automated and real-time way. The time for decisioning.
Okay.
So, it can be in a matter of minutes, and funding can be same day,
right, relative
to an offline process that can take, pages and pages of forms and weeks to get a decision. So we're looking at things that, as I kind of alluded to before, and it's hard to quantify, but to 10x the customer experience. So they're thinking about a loan, they have it in their bank account that day, and they haven't really had to do much in terms of administration to make that happen. But at the same time, the quality of that decision is sufficient to enable, appropriate default rates and arrears rates to go to profitability and returns.
And Geoff and Simon, just two quick things from you. Again, Geoff, from the SME space, is there a particular kind of service-based attribute, technology-based attribute that you think is really underserved, and if you were looking to invest money now, you would be focusing on?
I think there's some really interesting things that are being done with extraction software linking to accounting packages and other things. But I think also, from my perspective, the other interesting thing, which isn't so much driven by technology, is there's some interesting things within trade finance and other areas which require more complex documentation and understanding how that all interrelates in a way that the banks can't really get involved because of the risk committees now will just reject it because it's something they don't do anymore. Those are very big scalable opportunities which are in the kind of too difficult to do bucket for most people.
And Simon, finally, again, are there any particular things, some USPs now looking forward, actually either from an equity or debt perspective, that either tech or service or niche provision that you're really interested in?
Well, I think as sort of international participants in this space, finding a team of people in a jurisdiction that can bring the pieces together in their own market, so be it relationships with the investment community, local banks, people who are going to help them originate borrowers. Direct Money is an example of a business that's now brought an investment bank into its sort of funding web. And from being an outsider, seeing a business who's got those capabilities in their home market is obviously helpful.
And actually, one very last thing for you again. What one particular niche would you be looking for at the moment, either in technology, service, or people?
What particular niche?
Yeah, on something, one particular thing, USB, that a platform approach you got, like that kind of thing.
I think access to customer base is very, very important. That's why we partner with Square, and we're trying to find others who can do that in a cheap and efficient way as possible. And then linked to that is actually underwriting too. Can you underwrite faster, quicker, better than your competitors?
Okay, cool. Okay, lots of useful clues there for many of the younger businesses here. Put your hands together. Thank you very much for this platform, this event. Thank you very much. Okay, I'm going